Good morning, and thanks for everyone for taking the time to listen to us today. My name is Yaron Naymark. I am the founder and portfolio manager of One Main Capital, and I just want to take a second to thank Ian and Mike and everyone for organizing this week's event. All your guys' contributions allow us. We have a very vibrant and thriving community here for MicroCap nerds, and I think it's great that we have this. So thank you. So again, my name is Yaron. I'm the founder and PM of One Main Capital. And for those of you who don't know much about me or my background, I've been, a student of the craft, I would call it, for pretty much my entire life. At first, it was a hobby when I was younger. And for the last decade plus, I've been playing the game professionally. On the hobby front, it really started when I was really, really young. My parents are immigrants. They came here without a college education. They had a small little business. They had friends who were also immigrants without college educations who, came here and started businesses that ended up being much larger. And, some of them made life-changing amounts of wealth through business at relatively young ages. So I was just kind of enamored by that. And then my passion for it really grew when I started working for money. In middle school, I was a babysitter. In high school, I was a lifeguard, and I worked at the local Guess Jeans, folding clothes at the retail store. And in college, I was a server at the Olive Garden, and I made sandwiches at a local bagel shop called Einstein Bagels. And I saw how hard it was to work for $7 an hour, and saw what my parents' friends were able to achieve, and figured investing in business was the way to go. So at some point along the way, I started reading, the Warren Buffett letters and the Klarman letters, like probably everyone here has done, and decided to pursue a career in investing. I started out, in private equity on the investing side for a few years, and then, worked a bunch more years at hedge funds. And then in 2018, the fund I was working for was shutting down, and I decided that instead of going and taking another job, I'd go launch something on my own. So, I've been running One Main Capital for just about 5 years now. And the strategy is, it's pretty basic and simple. It's concentrated, long biased public equities. I have a value and a quality bent to my strategy. And the goal is really just to put up best in class performance for a very long period of time without going too far out on the risk curve. By utilizing kind of the strategy that I've honed for my entire life since childhood. I was just studying businesses, and I think I'm a pretty good business analyst. I think I'm good at evaluating management teams, and have a pretty good feel, I think, for portfolio construction and risk management. That's kind of the the overview of the firm and the strategy. In terms of the way I achieve those best in class returns without going too far out on the risk curve, is by putting a vast majority of the fund's capital into what I call these core positions. These core positions are, I define them as high quality, predictable, well run, well-capitalized businesses that are cheap on earnings or free cash flow 3 to 5 years out. And typically, we have 10 or 15 of these types of positions that make up, maybe 90% of the fund's capital. And then I also supplement these positions with higher octane, what I call opportunistic positions, which I tend to size smaller because they're just riskier and lower quality type businesses, but they have a really big upside convexity. And typically, I can have anywhere from 0 to a handful of these in the portfolio, and maybe they make up 0 to 10% of the fund. I would say I've made good money on both core and opportunistic since inception over the last 5 years. On the core side, I've owned RIC, RCI Hospitality, since inception. I've bought a lot of shares at $15. It's at 70 today. I've owned KKR for 3.5, 4 years now. That's gone from 20, where I was buying it, into the 50s. And on the opportunistic side, I've had a few investments where I made 5 or 10 times the fund's capital. And, even though they've been sized smaller, they've contributed meaningfully to performance over time. So made money in both categories. Batting average is not perfect. I've definitely lost money in both types of investments. And I'm definitely not wed to any of my positions, as some of you know. If the facts change, or my conviction changes, I don't hesitate to blow out of my position. So please keep that in mind as you guys kind of listen to the idea I present today. Do your own due diligence. Understand that I'm not always right. We could lose money, and yeah, if the facts change, so will my position sizing. But today I'm going to present an opportunistic investment, one of the higher octane ones that I think could be up 5 to 10x over the next 1 to 2 years. And obviously, like any good 5 or 10 bagger, we're going to benefit from significant earnings growth and free cash flow growth. But also, like any good 5 to 10 bagger, anyone who pitches it to you is probably smoking something or pitching something that has a lot of downside risk. So please keep that in mind as you guys do your research or decide whether you're going to buy any of this name or not. In terms of the business, this company, it sells wheels into the automotive sector. It's a leader in its core markets. Its unit volumes and profitability. Well, its profitability is tied to unit volumes, and unit volumes are tied to passenger and light truck volumes, production volumes in both the US and Europe, where it's the number 1 or number 2 player in its various markets. And, as many of you guys know, unit volumes for the auto sector are just very depressed coming out of COVID. There have been supply chain issues. In particular, most recently, there's a chip shortage. And so, this is a slide that kind of shows you what light vehicle production looks like in the US and Europe for the last few years. In 2018, 2019, and even going back, if you go back 5 years before that, we were averaging probably 35 million cars on the light vehicle side between the US and Europe per year. In COVID, it fell to 27, and we haven't really recovered from that level because of the chip shortage I highlighted a minute ago. And, this is a chart of US domestic auto inventories. I'm sure, some of you guys have probably noticed that there aren't a lot of cars in dealerships. And I'm sure everyone's seen headlines on what's been happening with used car prices. They've come in a little bit this year, but they're still 50% above where they were in 2019. And what all this tells you is that there's significant pent-up demand for new cars, and that when the chip shortage is finally done playing its course, which I think will happen in the next 1 to 2 years, I think we're going to see significant improvement in volumes and obviously profitability as well for this company. This slide, continued shift to premium wheels. So on top of the growth in industry production that I expect to come over the next 1 to 2 years, there's also an ongoing shift towards wheels that have more premium content in them. And this allows this company to grow its pricing per wheel. So as you can see on this slide, lightweight technologies are expected to grow at a 14% annual clip through 2025. Premium finishes at 11% over the same period, EVs in the 30s. And of course, I'm sure all you guys have noticed that more and more cars are coming with bigger and nicer wheels, 19-inch and larger are the premium sizes, and those are growing at a high single-digit CAGR. So all these technologies are kind of taking share of the wheel market, which are driving revenue and margins higher on a per-wheel basis for this company. So yeah, an important part of the thesis here is that we're going to benefit from earnings growth, but we're also going to get a much better balance sheet in the coming years, which the company needs in order to address its capital structure. It's going to end this year with around $450 million of net debt against $175 million of EBITDA, so a bit over 2.5 times levered. And their term loan matures in May of 2024. And they have some bonds that mature in the summer of 2025. So by this time next year, the term loan is going to be considered current. And if we don't refinance it by this time next year, we're going to have a going concern in our audit, which no investors like to see. But I do think by this time next year, net debt will also decline from 2.5 times leverage to 2 times leverage just through EBITDA growth and some cash flow generation. And so on its own, that sounds totally manageable. 2 times leverage, I think any business could handle that. So Doesn't sound too bad, right? But we have a problem. That's not the only thing that investors are worried about is the debt. The company also has a convertible preferred instrument that it issued to TPG to fund a European acquisition back in 2017. And it's a mandatory redeemable convertible preferred security, which sounds scary. Mandatory redeemable. Oh my God, TPG can force us to redeem this. And it's even worse because while it shows up on the balance sheet as 200, it's actually going to be redeemed for 300 million by 2025, which would add another 1.5 turns of leverage needed to take out the caps to complete the recapitalization of the balance sheet. So, that sounds scary, right? A cyclical auto supplier needs to take on 4 times leverage in this environment to recapitalize the balance sheet between now and 2024, right? Might not be for you. Well, this mandatory redeemable convertible preferred instrument, it's an equity instrument. That's important to kind of understand because the company's inability to repay this cannot put them into bankruptcy. I'll repeat that. The company's inability to repay this instrument to TPG cannot put them into bankruptcy. So the company could have just basically stranded TPG as long as they can keep paying the dividend on this instrument, which is very manageable, then they could take their sweet time to repay it. So really all we need to think about here is 2 to 2.5 times of net debt to EBITDA can recap the entire thing, and the convertible preferred can be stranded and be paid back over time. The companies, I've asked the company numerous times about this. They've confirmed it. They've even added a disclosure into their 10K this year that confirms that. And, there's really no risk that this could tip them into insolvency. And in fact, if the recovery takes hold the way I think it should, then, in terms of auto volumes in production, they should be able to recap the entire thing, including the TPG instrument, in one fell swoop in the next 12 or 18 months. But even without that, the equity is not really at risk here. So here are my financial projections. I think within 2 years, the company will grow EBITDA significantly. Unit volumes are going to recover both in North America and in Europe. And then you have the mix of higher premium wheels that come with a higher price point and higher margins will allow the company to grow both revenue and profitability to levels that are meaningfully higher than the pre-pandemic levels. Incremental margins and decremental margins have usually been around 35% here, I think, and that's on an EBITDA basis. I think incremental EBITDA margins on a big volume recovery will be much higher than that, but you don't need to believe that in order to think that this is going to do really well, this stock. And so once you do have the recovery, I think profitability is up a lot. The balance sheet looks much cleaner, and there's a lot less hair on this name, so it becomes more ownable. In terms of valuation, here's some potential math around this company. By 2024, I think EBITDA grows to around 250 million. I think net debt is paid down by around 150 million compared to the current net debt balance of 770. I think it'll be down to 620. For reference, the market cap of this company is just around 100 million today. So I think they're going to pay down 150 million of net debt on a $100 million market cap today. And all that math shows you that, if I'm right, the equity can appreciate from just below $4 today into the 30s. And I think that gives you a 5 to 10 bagger here. So I know you're all eagerly waiting for the name of this company. It's Superior Industries. The ticker is SUP. Again, Superior Industries, SUP. So some catalysts and risks. Obviously, the key catalysts are recovery in production volumes, improved profitability, which drives EBITDA higher and also drives leverage lower. So the combination of those two things, improved profitability and lower leverage, I think will be a huge positive. I think, as the market cap grows, this becomes eligible for index inclusion again. So all the typical things you see when you want to look for 5 to 10 baggers, more institutional buying, more profitable, more cash flow, less leverage. And of course, I think a big catalyst is me talking about it today. Just kidding. I don't actually think that. And then in terms of risks, obviously I stated it earlier, but this is a levered business. I think there's a lot of downside. If I'm wrong, this could be a zero, and if the facts change, I will be out of this. But I think I'm right, and I think we're going to make 5 to 10 times our money on it. So I'm fairly excited. And so if you have any questions, happy to take them now. If not, you can contact me at Yaron at onemaincapital.com. And thanks for taking the time to listen today, everyone.